Transfer Pricing Summit hosted by the SA Institute of Tax Professionals kicks off in Johannesburg tomorrow. Attending is the European Director of Transfer Pricing at Hogan Lovells in London, Fabrizio Lolliri. Great to have you with us, Fabrizio.
Thank you very much.
You've looked at global profit shifting. So
Yes.
how big is the scale that we're talking about?
Well, we're talking billions and billions, especially when we look at the value of certain transactions, especially in relation to intangibles. When we look at the value of brands or technical intellectual property, that often makes up almost the majority of the enterprise value of a whole group. So we're talking about shifting a very large amount of.
So here it's in the spotlight in relation to mining, but it can actually relate to a whole range of goods and services.
Absolutely. So transfer pricing in general applies to any sort of what we call an intragroup transaction. So as long as you have two related parties, they're exchanging goods, services, or exploiting a brand or intellectual property from one of the other entities, then transfer pricing applies.
So it's perfectly legal in most places, but is it being seen increasingly as unethical?
I think the problem is not transfer pricing per se, is how you apply it. The main principle of transfer pricing was put in place to ensure that related parties within a multinational would interact the same way as you would interact with a third party. Okay. So the cardinal principle of transfer pricing is called the arm's length principle, and it's basically saying you should interact the same way as you interact with a third party. Then the problem is on how you apply it and how you justify that you should have a certain margin, let's say in South Africa, and then another portion of that margin, let's say in the US or in the UK or wherever the related entity might be. So the rules that have been put in place to ensure that the pricing is arm's length, so it's fair pricing, market pricing, need to be followed. It can be sometimes difficult to understand where the real value is. And I think that's probably what's causing a lot of the times sort of having too much profit in certain jurisdictions and not recognizing that the jurisdiction that perhaps get the smaller margin is actually adding quite a bit of value to the business.
Can you explain, because you're saying it's at arm's length and these multinational
Yes.
groups should or subsidiaries should deal with each other as if they weren't associates.
Exactly.
But it sounds like the profits are being suppressed in high tax countries and grown in low tax companies, which looks like an overall strategy of the multinational. Is that correct?
There is absolutely a strategy of multinationals to look at potentially having their bulk of their margin taxed in a more favourable jurisdiction.
Tax?
I think it's dodging tax if you're doing it because it's artificial. I think if it's a commercial strategy. So, for example, if you are, let's say that you've got a South African brand and you're trying to promote it in a complete different market, and let's say you want to try and penetrate the European market, being able to control that brand in Europe, where you actually understand how the market works, what the customers actually want. So you actually need to have substance, you need to have people that can grow that brand for that particular market. So in that case, a portion of that margin going to Europe makes sense and is commercial because
Sure.
it follows the commercial strategy. If you're putting in place, let's say you just move it to a jurisdiction that has a low tax rate, but where it makes no sense to have that brand, then it becomes more about trying to reduce your tax rate rather than being commercial, and at the same time perhaps taking that tax advantage as well.
We are particularly concerned about mining, and I
Yes.
guess that's commodity. So already
Yes.
there's this history where they sold off cheaply and the value-added goods come back
Yes.
to Africa. So it's a huge concern. If South Africa wanted to try and clamp down on this, do you think we could, if it's a global practice?
I think if we look at the UK, for example, so we look at the BEPS that you mentioned, base erosion, profit shifting rules that have been looked at in the UK, the idea is to look at the whole of the value chain. So we look at mining, so we look at how you go from extracting the minerals to actually get to the finished product. And it's looking at where the value should be. And sometimes, I think especially in the past, transfer pricing uses different economic models to describe or to price basically what margin you should have in South Africa, what you should have in all the different jurisdictions that are involved. And transfer pricing heavily relies on the use of comparables and in the way that you describe the activity, the functionality. So if you're saying that in South Africa all you're doing is extracting the mineral and effectively then you're selling it on and all the added value work is done elsewhere, then effectively you're making, yes, exactly. So it's not, I think the problem is in trying to retain what are the actual risk-taking and value added functions in South Africa, so that you can justify that the majority of the margin should be taxable in South Africa.
I get you. So it'll be hard to justify. Last question, because we're running out of time. If it is found to be aggressive, though, I mean, say we're underselling based on the fair value of that commodity, even. Are there examples? I believe China, India, and you're talking about the UK. At least, are they setting precedents with how to deal with this?
Absolutely. And well, the UK is looking at ways to rethink the way we allocate margins to the different subsidiaries. So in saying, well, if it's the mining industry, then there's certainly a lot of value in finding where the actual minerals are, extracting them and so on. So you could actually allocate somewhat more value and therefore boost the margin. Another way that the UK is dealing with the profit shifting is to try and push multinational, incentivize multinational to retain creativity and bring creativity to the UK. So rather than going for a higher tax rate, they're actually offering a lower tax rate and saying, well, if you want to keep the creativity in the UK, we'll give you a tax advantage. So they're using that as a way to compete.
Innovation.
Exactly.
I'm allowed a final question. So I guess isn't the bigger problem, Fabrizio, that we have whole companies that move to low tax havens. So Google is often cited as depriving countries of billions of dollars in tax revenue by just focusing the operations there. Is that the bigger global problem? And people are talking about the need for a global solution, because as long as you have those tax havens, you will always have this sort of thing.
Absolutely, and that's why it's very important. Transfer pricing is very important, and if all the jurisdictions adopt similar principles, then it's easier to deal with the way you shift the margins or you allocate margins to the different jurisdictions. The problem is when you have different ways of dealing with the transfer pricing, different rules, even though they might be based on the same guidelines, different ways of looking at it, different ways of the tax authorities of managing the transfer pricing and auditing companies. So one of the things that is being looked at the moment at the level of the OECD, which is sort of the OECD guidelines of what we call the Bible of transfer pricing, is to really looking at a sort of country by country reporting. So multinationals having to disclose information about their transfer pricing in all the different jurisdictions, what they do, what they don't do. Therefore, you have a global picture of where the functions are, where the risks are, and therefore then you can, when you're assessing whether that margin is fair or is too low, you have a global picture.
Well, this has been fascinating, and I guess there will always be winners and losers, so it'll be interesting to follow those trends. Thank you so much for your time.
Thank you very much.
That was Fabrizio Lolliri from Hogan Lovells.